You know, in investing, they always tell you there are no guarantees. But what if I told you there's a return hiding in plain sight? A return that doesn't depend on you picking the next home run stock, but on just being smart with your strategy. Today, we are diving deep into tax loss harvesting and how you can use it to literally generate your own alpha. I love this quote because it completely flips the script on how we think about returns. Most of us just accept taxes as this huge, unavoidable cost of investing. But what if you started looking at your tax bill as a source of synthetic returns? It's outperformance that you create yourself, not by taking on more risk in the market, but simply by minimizing the money you give away. It's kind of like finding a massive coupon for your tax bill. So that really begs the question, right? Is there really a guaranteed return on investment in the market? And while, nothing's ever truly free, tax efficiency is probably the closest thing we're ever going to get. It's not about taking wild risks, it's about reducing the financial friction, that constant drag that silently eats away at your wealth year after year. So let's unpack exactly how this all works.
All right, so here's our roadmap for today. First, we'll define what we mean by this guaranteed return. Then, we're going to expose the silent killer lurking in every portfolio. After that, we get tactical. I'm talking how to actually harvest losses, how to master the supercritical wash sale rule, and how to avoid the biggest psychological trap. And finally, we'll run the numbers and see the exact payoff over 10 years.
Okay, let's kick things off with Section 1, the guaranteed return. We're going to talk about generating something called synthetic alpha. Now, in the finance world, alpha just means beating the market. Synthetic alpha is how you can beat the market without picking a single winning stock. You do it by strategically clawing back money you would have otherwise handed over in taxes.
And this right here, this captures the entire mindset shift. Most investors, they think about taxes maybe once a year, right during that mad dash in April. But a strategic investor, they're thinking about the tax implications of every single move they make. They know that a dollar you save from taxes is actually way better than a dollar you earn in the market. Why? Because that saved dollar was guaranteed.
Before you can solve a problem, you've got to understand what you're up against. And in investing, the biggest enemy for most people isn't a dramatic market crash. It's the silent portfolio killer, taxes. It's the slow, corrosive drain on your growth that can cost you an absolute fortune over the long run.
So before we jump into the how-to, you really need to understand the stakes here. I'm serious. This isn't some small leak in your portfolio. It's a massive hole in the boat. The long-term difference between a tax-efficient strategy and a tax-inefficient one is staggering, as you're about to see.
Okay, just look at this table. It tells a pretty shocking story. You've got two investors. They start with the exact same 50 grand. They even get the same 10% annual return. The only difference, investor A is smart about taxes. They buy and hold, paying lower long-term capital gains. Investor B, on the other hand, trades all the time, triggering those really high short-term capital gains taxes every single year. And the result? After 20 years, there's a difference of over $114,000. That is what the source material calls the acidity of taxes, just eating away at your money.
Okay, now that we're all sufficiently terrified of what taxes can do, let's talk about the solution. This is where we finally go on offense. Welcome to Section 3, How to Harvest Losses, or as I like to call it, how to turn your portfolio's inevitable lemons into some seriously valuable tax-saving lemonade.
At its core, the concept is actually beautifully simple. Look, every single investor has positions that go down in value. It's just part of the game. Tax loss harvesting is the strategy of intentionally selling that losing investment. By doing that, you turn a paper loss that's just sitting on your screen into a real, tangible tax benefit that you can use to cancel out gains you've made elsewhere.
So let's walk through the mechanics. Step 1. You sell that stock or ETF that's in the red. Bam! That makes the loss official for tax purposes. Step 2. You use that loss almost like a tax credit. It first goes to wipe out your capital gains, starting with the highest taxed ones. Now, what if your losses are bigger than your gains? Well, you can then use up to $3,000 to lower your regular taxable income, like from your job. And if you still have losses left over, you can carry them forward indefinitely to use in future years. It is truly the gift that keeps on giving.
Okay, I know what you're thinking. This sounds almost too good to be true. And well, there is one critical catch. The IRS is not dumb. They know you can't just sell a stock for a loss and immediately buy it back to game the system. And that brings us to maybe the most important rule in this entire explainer, the wash sale rule. If you get this wrong, the whole strategy is completely useless.
So what exactly is the wash sale rule? Well, think of it as the IRS's way of making sure you've made a real economic decision. They basically say, look, if you want to claim a tax loss, you have to genuinely part ways with that investment for a little while. If you sell a security and then buy it or something substantially identical right back, they call it a wash, and your loss is disallowed for tax purposes. You get no benefit.
And that little while is a very specific 61-day window. This is the key. It covers the 30 days before you sell, the day of the sale itself, and the 30 days after you sell. During this entire period, you cannot buy that security back. So, let's say you sell on November 15th to harvest a loss. You cannot buy it back until December 16th. This is a hard and fast rule you have to follow.
So this brings up the multi-million-dollar question, doesn't it? You want to harvest a loss on your S&P 500 fund because the market is down, but you're still bullish long-term. You can't just sit in cash for 31 days and risk missing a huge rally. So, how do you book the loss while staying invested in the market?
The answer, my friends, lies in that very specific phrase, substantially identical. So while you can't sell Vanguard's S&P 500 ETF, ticker VOO, and just buy VOO right back, you can immediately buy a similar but not identical replacement. For example, you could sell VOO and in the very same minute buy Schwab's Large Cap ETF, ticker SCHX. It gives you very similar exposure to the US stock market, but it tracks a different index from a different company. This lets you stay in the game while legally booking that loss. And be careful, this rule applies across all your accounts. Selling a stock in your brokerage account and buying it back in your IRA? Yep, that's still a wash sale.
Okay, so we've got the nuts and bolts down. Now let's talk about the mental game, because a great strategy can be totally ruined by bad behavior. This section is a huge warning. Do not let taxes trick you into making a bad investment decision. Your investment thesis has to come first, always.
You have probably heard this classic phrase before. The investment dog is your main reason for owning something, your belief in its long-term future. The tax tail is just a secondary thing to think about. The dog has to lead. The second you let a potential tax saving dictate your buy and sell decisions, you're letting the tail wag the dog. And that, my friends, often leads to disaster.
Let me paint you a picture because this is where people really mess up. Imagine you own a fantastic company, one you believe in for the next decade. It has a temporary dip, so you get tempted and you sell it just to get that tax loss. But then, while you're forced to sit on the sidelines for those 31 days, the stock rips 50% higher and you miss the entire rebound. You let a small tax deduction cost you a massive investment gain. The rule is simple. First, ask yourself, do I still want to own this investment? If the answer is no, sell it. If the answer is yes, then and only then do you consider harvesting the loss with a similar replacement.
All right, let's bring this all home. We've covered the strategy, we've covered the rules, and we've covered the warnings. Now for the most important part. What's the payoff? What's the actual tangible benefit of doing this year in and year out? It's time to quantify the tax alpha.
This simulation really shows the power of the strategy. You've got two identical portfolios. Both start with $100,000, both earn the same 8% a year. The only difference is that the second portfolio consistently harvests an average of $5,000 in losses every year. The tax savings from those harvested losses are then immediately reinvested right back into the portfolio. And that immediate reinvestment is where the compounding magic really happens.
And here it is, the result. After a decade, the proactive, tax-savvy investor has an extra $11,500. And remember, this isn't from better stock picking. This isn't from taking on more risk. It is pure tax alpha, a return generated solely from smart tax management. It's literally money you created by turning your portfolio's inevitable losses into a powerful, portfolio-boosting asset.
So the final point is this. Every year that you ignore this strategy, you are actively leaving money on the table. You might be getting the same returns from the market as a more sophisticated investor, but you're keeping less of it. This is one of the very few parts of investing that you can actually control. So the question I'll leave you with is this. Are you actively generating your alpha, or are you just giving it away?